Good morning, good day, or good evening to all of the All-Star Financial clients and or friends or potential clients. Welcome to our quarterly review and preview webinar. This one is titled Battling a Debt Hangover. I hope we don't have one too long, but again, welcome everybody. This is our feelings and thoughts, kind of coincides with our newsletter. And for those of you who cannot come in, I hope you enjoy it, and we'll look at visiting together face-to-face next quarter. If we look at kind of a market overview, we had a nice bounce, obviously, recovered a great part of our loss from 2007 to 2008. I know at All-Star Financial we've actually recovered all of it. The market's still probably 20 to 30% below water. All of our clients have made back their dollars. So after a nice bounce, we've really still looked at an economy that looks pretty sluggish, and that's because of the debt concern that we have. We have debt concern in Europe with the JIT nations of Greece, Ireland, Portugal, and Spain, the sovereign debt problems that they're having right now, initially with Greece, and now obviously a little bit more with Ireland and Portugal and Spain. Italy has kind of come to the forefront here. That debt hangover as well in the U.S. has caused problems, and obviously political games being played today with those problems too. Hopefully we can get those solved and on to bigger and better things with the economy. When you look at the economy for the first quarter, it came in at about 1.9%. Second quarter is estimated to be approximately that as well. Cause of the slowdown really has been oil prices for the beginning part of the quarter. They came down late in the quarter, but fears of supply interruption and kind of a worldwide demand going up created those problems because of the issues with Japan and the earthquake and tsunami there. We also had significant regional problems, whether it be floods, fires, tornadoes. And unemployment is up, and unemployment obviously is a big part of what we need to fix. I think it's kind of a three-legged stool. We need that unemployment fix, we need the housing problem on the right track, and then obviously our debt concern. If we were to actually count part-timers and people who really kind of given up, it's probably almost 17% too. So we need to kind of solve that problem and get a little bit better. Looking forward on the economy, though, there's still a feeling, I think, for most people that we're still in a recession. The confidence and sentiment on consumers and investors is still pretty low. We are benefiting, however, from the low valuation of the dollar on our export growth. Energy prices have come down recently, so that's a benefit to our economy, a little bit less costly to get around. Business tax incentives that end on 12/31, we think that there's going to be a push to use those before year end. So the last half of the year here, we'll see some increased spending on the business side. And continued low interest rates is always a huge benefit. The bond market was really a surprise for us, actually. All of the bonds were pretty strong. You look at the 10-year decline, or 10-year note declined anywhere from about 2.45% to 2.87% during the quarter, and that was built on kind of the fears that were surrounding a lot of the debt problems. And when that happens, people put money into the U.S. and put money into our government bonds. So interest rates went down surprisingly again for the umpteenth quarter in a row. Everybody benefited. TIPS were up 3.66%. Aggregate was up 2.29%. Government bonds 2.22%, and corporate bonds anywhere from 2.2 to 3.9. As you see, looking forward, we also have thoughts that it's probably the day in the. I've said this now twice, but I think the bonds have had their day in the sun. We think they'll remain relatively flat, and the next move will be up. When we really like high yield still, the spread there is good, and emerging markets, I think, give us our best bet from a risk-reward beyond high yields. So when we look at kind of the domestic market and what happened there, we really took a roller coaster ride We were up early in the second quarter, then declined in May and until about the first or second week in June, and then we came on with that June rally. Specifically, those last 4 days of the quarter, we were negative 4 to 4.5% on most indices before that last week rally that created almost a break even. So up, down, up, roller coaster. Some of the positive sectors were defensive related. Healthcare is always good when things are uncertain. They were up 7.26%. Utilities had a lot of money put into it. Consumer staples. Negative sectors were the financials again. Energy had a concern, obviously, with the oil prices dropping late in the quarter, and technology didn't quite do as well as what we would have thought because of some of the export growth. But overall, there was a risk aversion to the market. Large caps did better than small caps. Value did better than growth. So again, a relationship to risk and reward there, which is fairly typical with uncertain markets like we're seeing. So looking ahead, we really still believe there's an opportunity. There's still strong corporate earnings growth. Valuations are attractive relative to long-term history, low interest rates, low inflation. They're all good, positive signs, but the debt problems really need to be addressed, and we could honestly put a question mark behind opportunity still there because I'm not sure it is. I think it is, but we need that debt problem solved and the confidence from a kind of a worldwide economic and monetary flow. Cyclical growth stocks really did pretty well. They benefited from the lower dollar, and the valuation of the dollar created more incentive to buy U.S. products. So our exports did really well, specifically in the technology, materials, energy, and industrial stock side of the world, we think, going forward. International stocks, really, emerging markets underperformed for about the third quarter in a row. Europe was up on average about 2.44. Predominantly two countries that drove that, Germany and France. Everybody else, as we've talked about, has some significant debt problems. Japan was, like us, fairly flat to the world. And emerging markets, as we said already, were down, but show strong signs of growth. So when we look at kind of going forward, the GIPS, the Greece, Ireland, Portugal, Spain, we can add Italy in there. There's still concerns. The ramifications of those guys defaulting to banks worldwide, obviously, is pretty significant. So those issues have to be addressed, and I think they are as we speak. The Japanese surge, as far as the rebuilding, I think would be positive. That's going to bring flow of money to Japan and other countries around it as they get their house in order. And inflation, I think, is tamed, and as always, that's a positive for equities. So real quick summary here, and we want to try to keep this about under 10 minutes. The summary here for us would be the biggest risk we still face, I believe, is policy risk. Does the governance do, or in most cases right now, not do what they should be doing? And I think that that's a really huge problem. We could really do everything right, but have some decisions on the governance side of the equation that could really hurt us. European debt and U.S. debt is still a very big concern for us. Underlying fundamentals, as we've talked about, though, are still strong. Earnings up, dividends up, inflation and interest rates low. That's always a positive sign for equities in the history. And we could actually add a fourth benefit there is companies have more cash than they've had since the early 50s. So fear is prevalent. We think that's a good thing for long-term investors. If you look at the market where you want to be as a long-term investor, you want to be buying when everybody else is fearful, and that's really the point in time we're at right now. You don't want to give up the ship. You don't want to exit. You don't want to leave the party. You really want to be going to the party. The reason I say that is that these are some of the best values we've seen in a long time. Good example, PE ratio in the U.S. right now is about 12.4. The average over the last 10 years is 15.2. The last 15 years, 17.1. So very cheap. Foreign developed countries, PEs are about 11.6. Last 10-year average is 14.2. So again, a good deal. In emerging countries, we're still the lowest valuation at 10.4, and the highest growth at 4 to 9%. So we really look at what we've done for you is really added a few exposures, the commodities and materials into your domestic stock exposure. That we looked at kind of as bond exposure typically. So we have about 9% on average in our clients' portfolios in those two funds. You take that 9%, we're underweighted domestic. We're a little overweighted international still, and that overweight is in the emerging countries. But we feel like we don't want a lot of money in cash, so our cash money is in our bond portfolio. We don't run a lot of money in bonds, so some of our bond money is in that alternative investments that I talked about on the domestic side. So at this point, we think we're ready to go and feel confident that we're in the right position. We just hope, as we talked about, the governance takes control and does what they need to do. Thank you again for your trust in the All-Star Financial team. Remember, our referral program can help reduce your fees, and do not hesitate to call. Appreciate what you've done for us and what you've made All-Star Financial as a wealth manager. We wouldn't have been able to do it without you. Please give us a call if you have any questions. Have a great